Hello and welcome back to the Note. We've had a lot of excitement around the area of fossil fuels divestment recently. Even the Norwegian Sovereign Wealth Fund is going to be selling all its coal stocks, and of course the Pope now appears to be in favour of some kind of fossil fuels divestment. So I've written a big read on the subject of responsible investing in general, and I'd now like to take you through some of the key points. First of all, it's growing. It is really quite remarkable how many assets are in fact run according to some kind of ethical mandate. Globally, as these figures show you here, it's some 30% of all institutionally managed assets around the world are managed in some quote-unquote responsible way. In Europe, it's more than 50%, largely because there are quite a number of countries there where the law bars investors from investing in companies that produce landmines. You can see across the world there is an increase in this kind of investing. Now, traditionally, responsible investing means divestment. It means excluding stocks that you dislike. But the history of that kind of investing isn't necessarily that strong. This is a chart produced by London Business School earlier this year. It shows you how the tobacco sector, perhaps the most popular sector to exclude from ethical funds, has done relative to the US stock market in the very long term, going back to 1900, and you can see despite all those divestment efforts, it's done very well indeed, better than any other economic sector. Now, more broadly, if we take a look at how ethically screened funds do, what we're looking at here is perhaps one of the most well-known ethically screened funds, the Ave Maria Roman Catholic Values Fund. Obviously doesn't invest in anything that goes against the teachings of the Catholic Church, and that's compared with the Barrier Fund, which used to be known as the Vice Funds, because all it invests in is tobacco, alcohol, arms and gaming. And you can see that over time it is the sin stocks that tend to win. Again, that's not surprising. They tend, because sin is a human constant, to have very reliable cash flows. When you sell them, all you do is make them that much cheaper for somebody else with less scruples when they buy them. So divestment, at least when it comes to an investment philosophy in terms of changing corporate behaviour, isn't obviously very useful unless it's combined with a big political campaign, as it was in the case of South Africa. However, what is interesting, even though people are so excited by divestment at the moment, is that the industry as a whole has now worked out that there's a better way to do this, which is to measure the positive externalities that we all care about, exactly how sustainable companies are, how they're managing to reduce their emissions, how they're managing to govern themselves better. There are many different efforts out there to improve this measurement. They are being used, and what we're showing you here is some Harvard Business School research. What you see here is a group of companies that chose to adopt a raft of good sustainability measures that were material to their performance. So this isn't like a bank deciding to reduce its carbon emissions. That doesn't have a huge impact on its bottom line. This is material changes to their policies compared to the group of companies that didn't choose to do that, that you could call bad sustainability companies. And you can see that the outperformance there was really quite remarkable over the long term. You can only expect that to improve as you see more active management happening. So you are seeing a shift towards active management, positively screening for good behaving companies, and using shareholder might aggressively to try to push companies in the right direction, not by divesting them, but by holding on to those companies and being active owners. That is the way that responsible investing is moving. Fossil fuels divestment seems a little irrelevant to that in some ways, but it certainly has helped focus even more interest on it.